Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend. Ira Epstein of Linn and Associates with your financial market update, and this is your weekend edition for Friday, the 7th of July, 2017. Now, before I get too far, in each video I am asking people, hey, if you have friends that might be interested in seeing this, please tell them about it. Send them out the link or YouTube or whatever you watch it on. It just helps us, and I try to help you. It's that simple. At the end of this, by the way, I've got a new offering, and if you like pivot point analysis, I've not ever discussed it. I think you'll enjoy it. So we get the employment number, and it's a blockbuster number in terms of new job creation, and it totally misses on wage inflation, and that has been the issue all the way along. We're getting the job growth, and the question, of course, is what is full employment? Believe it or not, the unemployment rate went up a tenth just because some people must be dropping out of the labor force, but we added 222,000 jobs. They're looking for 179, so you can't say it isn't a stellar number, and they raised the May number as well. That was revised. But wage inflation is elusive. It's just not there. It's not creeping. If anything, it's slipping. And that becomes arguments for something called the Phillips curve, which you'll hear a lot of talk about. And the idea behind that is that once you get to full employment to get more workers, in theory, you got to pay more money. You would think that's the case. Well, obviously, that isn't the case right now. It's not only that way in the U.S., it's abroad. So the stock market is reading that, and that's my interpretation of this, that, hey, the Fed doesn't have such an easy go that it wants to raise rates and shrink its balance sheet. If it can't get inflation under control, not excessive, but getting it going, why do they have to raise rates, and won't that even drive it lower? That is one of the arguments you're going to hear. The September idea on the CME Fed Watch page that we'd get a rate increase in September under 15%, and now you're at about a 50-50 bet in December. You were recently in the 70 percentile bet. So it's only the June number. We've got to get through July, August, and so on to get further along. But the September number, if you didn't have a blowout number in July and August, you can write that off. That's not going to happen probably at that point in time. So the dollar, stable off the number. It's missing the inflation. Yes, it's up a little bit because you're, well, what's the Fed going to do? But it's also a good number for the economy. So you got a bit of a bid there, an offer coming across the board here, and stocks rallied back up. Metal markets got hit, and there was another one of those what we call fat finger trades in silver where it gets hit because there's a big order that maybe shouldn't have been in. It goes down as fast and comes back up faster than it drops. All right. If you take a look at the monthly bar chart, it's hard to argue that you aren't just going up and continuing to do so. But I'm also looking at the ranges getting narrower and narrower all the way through here. They're not as big as they used to be. I don't know if that's part of the summer month that we're in or what, but you can't argue that you're not in an uptrend. When I go to a weekly area chart of closes, we had this correction right here. And from there, we have gone up and haven't taken out previous break lows. You can just visually see it. So you're still in very much of an uptrend on that chart. When we come to just a weekly bar chart with absolutely no indicators on it, this is what it looks like. And when I add the swing line, you get a better story. So now, if the market were to reverse course and get under 21,138, you could end up with the pattern of a lower low for the first time. What I don't know, obviously, is this week's high took out that week's high, so you could not end up with a downtrend if that happened in one swoop. You'd have a higher high and a lower low. And yes, this week's high is higher than the 21,494. When we look at where the market's at in relation to moving averages, trade prices taking place over the 18-week moving average of closes, which is over the 100-week. That's a bullish setup. When we look at potential resistance from a Bollinger Band, and let's review what a Bollinger Band is. On the chart, it's these black dashed lines. They do not run parallel to each other. This is an algorithm that's designed to keep the market trading within it 95% of the time. But that other 5% is comprised of when the market breaks out up or down from a lot of sideways action, or it starts trending in a sharp way, just the way it did here. You can get over it a short period of time, but 95% of the time, the market will trade up to it. What else? The first time it hits it is often an area where professionals take some money off the table. So that number is 21,554, which you haven't quite hit yet, but you're knocking on the door of it. In terms of momentum, the uptrend is just locked in. When this happens on a longer-term chart, some people call it embedded. I call it locked in on the longer-term charts. It's all the same. Until the red line gets back under 80, this trend is bullish. The bias is bullish. Momentum is bullish. Everything's bullish on that chart. Not the case in the NASDAQ. The NASDAQ has a clear pattern of lower highs. I've marked them with the red lines, and lower lows. The support in the market is the 18-week moving average of closes in red. The market fell to it and held it, did it last week and this week, and momentum is pointing down in the market. So we have the trend down. The bias is up since the market is over the 18-week moving average on the close, but momentum is measured by the slow stochastics down. On the E-mini S&P, you have a pattern of a higher high and a lower low, so you are not trending. That's number one. You certainly have upside bias because the market's over the 18-week average of closes, and momentum is still very much in the bull camp, but if the red line next week, and it could happen Sunday, when the market reopens, if it gets under 80, I will call that as then pointing down. In the Russell 2000, everything is bullish. You have a pattern of higher lows, higher highs. That's bullish. You're over the 18-week average of closes. That's bullish. And the market's momentum had been up. It's sort of stalling right here, and you can almost see that as the market's going sideways, but it's still said to be bullish. Now you get to the VIX, and the VIX did what it so often does. This is the daily VIX, not the weekly. And it's got the pattern of higher lows and higher highs, but each time the market has gotten up over the upper Bollinger Band, did it there, did it there, did it there, did it there, it's short-lived and it pulls right back in, and often it goes right back to that 18-day moving average of closes. Seems to be the pattern still at work here. We then go to the 10-year notes. First thing my eye goes to is momentum is pointing down. The second thing, you're no longer in an uptrend, but you're not trending either. You have a pattern of a higher high and a lower low. That is not a trend. What's the bias? It's down because prices are under the 18-week moving average of closes, the red line. So you've got momentum and bias down, and you're trendless. When I come over to the dollar index is bearish. The market has got a pattern of lower highs, lower lows, bearish. Under the 18-week average of closes, bearish. Momentum locked in a downtrend, bearish. So everything there is still bearish. Flip-flop to the euro currency, everything's bullish. You have a pattern of higher lows, higher highs. You're over the 18-week moving average of closes, which may also get over the 100-week as early as next week. And momentum locked in bullish. Everything looking good on that chart. Then we come to the British pound, which is a so-so chart. The momentum is a higher high and a lower low in terms of the swing line. So let's call it the trend. There is none. Second part of the market. The market has got an upside bias because it is over the 18-week average, and momentum had been up and it's sort of flattened out just the way we're seeing in some of the other markets. So running out of a little momentum here, we'll see what that all means. Canadian dollar, up, up, and away. Everything looks good on this chart. Now, what you have to be careful of is you're over the upper Bollinger Band. I don't care if the chart's a day chart, monthly chart, weekly. Markets do not stay more than 5% of the time over an upper Bollinger Band. Getting up to it and over it is a sign certainly of strength, and you've got that in the terms of the trend is up, higher lows, higher highs. The bias is up because you're over the 18-day average, and momentum is up. But that is a major warning sign. Be very cautious on that. In the Japanese yen, what you have is a market with a higher high, a lower low, no trend. The bias is down since you're under the 18-week average of closes. A downside target is in sight at 87.43. You're not too far away from that. Momentum pointing to the downside. In the crude oil, you try to rally this week and you didn't go anywhere with it. You've still got the pattern of lower highs, lower lows, bearish. You're under the 18-week average, bearish. The market momentum is pointing down, still bearish. Admittedly, in oversold territory, but bearish, and that's how I'm reading that. Nat gas, lower highs, lower lows, bearish in terms of the trend. Downside target, 282.5. You got to 283.2. You might hit it very shortly. And you're oversold, but momentum is pointing down. So when I look at that, that's how I'm reading the charts on the longer-term basis. Now, a lot of you like short-term trading. Some of you just want to be out at the end of a day. Others want 1- and 2-day trades. It varies by the person. There is a tool for it that's been around a long time. You may not know how to use it. You may not know what the tool is. And it's called a pivot point. And I've created 2 videos to help you learn it. The first video is going to explain it and teach you the formula. I do it all in PowerPoint so you can see it nice and easy. The second video takes you to actual charts, and I teach you the application of it so you can work with it. I'm even thinking of doing a third one so that I can tie some momentum indicators for it and really show you another technique with it. But let's see how many of you want to learn this, and it's pretty simple. You get these series of lines on a chart. The white line is your neutral number. You're trying, when you're selling, to sell the first line or the second line on the upside. When you're buying the blue line, the first one underneath, and or the second one. And you're trying to get back to the line if you're buying above you, and if you're selling to the lines below you. It's really that simple. And you're not holding on to come from the sell line beyond the white line that you saw, that midpoint. You're not trying to do that. You're in and out. And there are sometimes you're in and out a lot of times. Other times you got to carry a trade overnight or so. But I think you'll find it very interesting. And certainly another way to look at it, let's assume you're looking to get into a position and the market's giving you a hard time doing so. This could be a tool, and I've used it that way in my recommendations at times, looking to see maybe this is tying together with something that makes more sense than what I'm trying to do. How do you get it? It's free. 866-973-2077. Leave your name and number if it's over the weekend. You can go to our website, www.iraepstein.com. You'll see a carousel of free offers. Click on it. Fill out the form. It'll take the rest of the way. You can click up here if you're watching me on YouTube, and or if you're watching me on other websites. Underneath us, it often says, click here for Ira's free offers. Do so. We'll make sure that you get it. I'm Ira Epstein. You have yourself a great day, and I will talk to you all on Monday. Take care now.